Welcome to my 39th presentation for the team of finance and accounts. The topic is 68 causes that can adversely impact the financial reporting of current inventories in the balance sheet. Overall, this is my 70th presentation considering all the YouTube presentations that I have made so far. What I plan to include in this presentation are 7 types of inventory classification as per the revised Schedule 6 to the Companies Act 1956, Accounting Standard 2 requirements in India as per the Institute of Chartered Accountants of India. Inventory measurements or inventory valuation requirements. Tabulation of 68 causes that can adversely affect the reporting of inventories in the balance sheet from operational perspective and ethical perspectives. Internal listing of causes that can adversely impact their financial reporting. Internal controls for inventories to serve as strategic inputs. Inventory types or classification. As per para 9.5.1.2 of the Schedule 6 to the Companies Act 1956 and according to Accounting Standard 2, inventories are to be classified in the following types. Type 1 raw materials, type 2 work in process, type 3 finished goods, type 4 traded stocks, type 5 stores and spares, type 6 loose tools, type 7 others. Accounting Standard 2 requirements are: number 1, the inventory should be classified as per the previous slide. 7 types as I mentioned. Mode of valuation, inventory measurement method must be stated in the reporting for each type of classification. Number 3, change in the inventory of finished goods, work in process or stock in trade, etc. to be based on the material movement to be recorded and goods in transit to be captured. Measurement of inventory. Inventory measurement. It is measured at the lower cost or net realization value. Inventory cost the cost includes purchase cost, that is inventory for production is valued at its landed cost including purchase prices, duties, freights and handling charges. Duties include uh, import duties as well or GST, etc. Conversion cost. This is applicable particularly for the intermediate goods or processing costs for example for raw materials or semi-finished good inputs if applicable are to be added to the production inventory valuation. Other cost directly related to the bringing the inventory to its present location and present condition and location. For example, in the case of after sales spares, it is the packing and labeling cost. Net realization value, the estimated selling price in the ordinary course of business less the estimated completion cost and the cost necessary to make the sale. Fourth, the income statement must show an impairment cost if the NFV is lower than the cost. An overview of 68 uh, 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 causes that can adversely impact the reporting of the inventories in the balance sheet. Now, this is a table which shows 4 columns. Number 1, serial number 2, type of current inventories, number 3, operational causes, and number 4 column, ethical causes. There are 7 rows. Row number 1 represents raw materials or bill of materials as I called it for the end products. In this presentation, 6 operational causes and 5 ethical causes have been identified. For work in process row number 2, 6 operational causes and 4 ethical causes have been identified. For finished goods, 6 operational causes and 6 ethical causes have been identified. Fourth, for traded goods, 5 operational causes and 4 ethical causes have been identified, and so on and so forth. Overall, total 35 operational causes and 33 ethical causes have been identified, which can adversely impact the reporting of these inventories in the balance sheet. Number 1, raw materials or bill of material. In the context of the manufacturing industry, let's visualize raw materials as the bill of material that make up the end product. So what are the storage locations for the raw materials or bill of material? These are paid inventory lying in the receipt or QC store awaiting inspection. In the main store, inventory in the main store, paid inventory in the transit from vendors, inventory in the high sea shipped against LC, paid inventory identified as rejected in the receipt or QC store or rejection store but not yet debited to the vendor. Inventory lying with the processor or job worker as loaned for processing and subsequent return to the client. And 7, slow moving or dead stock or obsolete stock not usable. These are the various stages where the inventory can be found in any manufacturing plant. Now, operational causes that can adversely impact the reporting of raw materials inventory in the balance sheet. Number one, counting errors in the physical verification. It is either not correct or not reconciled and or not incorporated in the stock ledger. Number two, incorrect classification among the different type of inventories I talked about. 3. Applying inaccurate rates to the inventories for valuation purposes. Valuation errors. Incorrect valuation method, that is weighted average method versus first in first out method. Then inaccurate disclosures. Incorrect or incomplete disclosures as per the accounting standards, and not separate reporting of the slow moving or unmoved or dead stocks or obsolete stocks. Ethical causes that can adversely impact the reporting of the raw materials in the balance sheet. Number one, including damaged or rejected inventory in the stock and valuation. Number two, underreporting or not reporting stocks lying with the job worker. Number three, fictitious inventories, that is creating fake inventory records to inflate the inventory. Number four, manipulating the bill of material inventory by changing the material codes in the stock ledger system amongst the different type of bill of materials. And number five, including the obsolete stocks at full value. Type 2, WIP inventories, work in progress inventories. WIP includes the following in the context of the manufacturing of an end product. Number one, intermediate materials undergoing any processing till they become ready for assembly for the end product. For example, steel bars, raw forgings or casting, sheet metals, unpainted materials, etc., which need to be processed to make this fit for use. Number two, bought out or traded materials ready for use but lying in the production line or assembly line for making the end products. Number three, incomplete end products not in saleable condition. So these are all part of the WIP. WIP inventory valuation typically follows a cost-based valuation method similar to the raw materials, and common methods include WIP cost formula, which is the added direct material cost plus direct labor cost and a proportionate allocation of the manufacturing overhead incurred to bring the WIP to its current stage of completion. And number two, WIP stage of completion method. Assignment a percentage of the completion to each unit of the WIP based on its production stage and valuing it accordingly. Operational causes that can adversely impact the reporting of WIP inventories in the balance sheet adversely. Number one, counting errors in the physical verification of WIP stock. This is particularly true in the case of large plants having very large volume of production. Number two, incorrect quantity reconciliations. Number three, incorrect allocation of the overhead cost. Number four, miscalculation of the direct materials or labor costs. Number five, valuation errors, that is incorrect valuation method, weighted average versus first in first out. And number six, inaccurate disclosures, that is incorrect or incomplete disclosures as per the accounting standards. Ethical causes that can adversely impact the reporting of WIP inventory. Number one, including obsolete stocks or WIP rejections in the inventory count but not tagging such materials. By not tagging such materials and counting them as good. Fictitious inventories, including stocks already consumed in the finished goods in the WIP inventory to inflate the WIP. Manipulating inventory by allocating material code changes by interchanging the codes from raw material to semi and WIP or vice versa for the in-house processed materials. Then fourth, intentionally applying incorrect percentage completion to the WIP stock for valuation purposes. Finished goods inventories. Finished goods inventory includes the end products that are declared as okay by the quality control after the backflashing of the WIP in the production planning software and are ready to sell. Finished goods inventories valuation typically follows a cost-based valuation method similar to WIP, and common methods include FGS cost formula, that is adding direct material cost, direct labor cost, and a proportionate allocation of the manufacturing variable cost incurred to bring the WIP to the finished goods stage. Number two, lower cost or netization value. The finished good locations. The finished good locations uh, finished goods can be stocked at several locations, and these need to be properly counted. These are, for example, finished goods stocks lying as OK tagged awaiting transfer to the company sales depot or distributor or stockist or dealer or end customer. Number two, finished goods stock lying at the company sales depots. Number three, finished goods stocks in transit from the plant to the depot or depot to distributor or dealer or to end customer. Number four, finished goods stocks lying with the distributor or dealer or on credit and not yet paid by them. And this will obviously be then company's inventory. Then finished goods stocks sent as demo products at the exhibition or with the dealer or the distributor as a returnable stock. Operational causes that can adversely impact the reporting of finished goods inventories. Number one, missing out the finished goods inventory count during inventory verification process in various locations mentioned earlier. Non-timely backflashing of the work in process. Incorrect quantity reconciliation of the physical stock with the ledger for stocks lying at the plant at the company warehouses and unpaid stock with the dealers or distributor or end customers awaiting sales realization. Number four, miscalculation of the direct materials or labor cost or direct marketing variable cost. 5. Valuation errors, incorrect valuation method of weighted average versus first in first out. 6. Inaccurate disclosures, incorrect or incomplete disclosure as per the accounting standard. Ethical causes, the reporting of finished goods inventory in the balance sheet adversely. Number one, not accounting sales return of the finished goods though customer has already been credited with the sales value. Number two, including the opposite stocks in the finished goods stocks at total value, although sales relation would be much lower. Number three, including in the finished good inventory stocks that have been invoiced but physically not shipped from plant or company depots. Number four, manipulating the finished good inventory by changing end product codes in the stock ledger system amongst different models, having different configurations and different NRVs. 5. Including cannibalized finished goods from where, that is, cannibalized means those products from where some materials, some components have been removed and that cannot be sold till the cannibalized parts are replenished. Intentional misvaluation of the finished goods. So these are the 6 causes, ethical causes that can adversely impact the reporting. Trade stock. Trade stock refer to those inputs materials that are brought out from vendors and ready to use in end products or can be sold as spares for product service. Operational causes that can adversely impact the reporting of the trading stocks. Number one, counting errors in the physical verification, neither reconciled nor incorporated in the stock ledger. Number two, applying inaccurate rates to the inventory for valuation purpose. Number three, valuation errors. Number four, inaccurate disclosures. Number five, not separate reporting of slow moving or unmoved dead stock. I mean, these are basically similar to the raw materials. Uh, Ethical causes in the case of traded stocks, including the damage or rejected inventory or ready stock and valuing and their valuation. Number two, fictitious inventories, creating fake inventory records to inflate the inventory. Number three, manipulating the inventory by allocating material code changes. And number four, including obsolete stock at full value. Stores and spares. Operational causes that can adversely impact. Here by stores and spares, by spares I mean maintenance spares in the balance sheet adversely. Reporting counting errors. Here the causes can be counting errors in the physical verification. Number two, valuation errors, incorrect valuation method. Number three, inaccurate disclosures vis-a-vis accounting standards. Ethical causes can be number one, including damage or rejected inventory of stores and maintenance spares and valuation. Number two, fictitious inventories creating fake inventory records. Number three, including obsolete maintenance stocks as the plant and machinery for which these were procured and were to be used does not exist anymore and or has been disposed of. And fourth, incorrectly classifying maintenance spares as after sales service spares. Loose tools. Now, operational causes that can adversely impact the reporting of the loose tools inventories in the balance sheet. Loose tools are the ones which are used for processing of the raw materials, particularly in the context of the manufacturing plants. Now, the operational causes can be counting errors in the physical verification, number two, valuation errors, and number three, inaccurate disclosures. Here, The ethical causes are including damage or rejected inventory of loose tools in the reporting at full value, fictitious inventories. Number three, including obsolete stocks of loose tools. And fourth important point is that valuing the tools at full value, although tools have been worn out due to usage. Others. Here, by others, I have included after sales service spares as others. Now, what is the difference between after sales service spares versus raw materials or bill of material? Number one, after sales service spares can be bought from the vendors against custom design or traded stocks, or they can represent processed WIP which has been fully processed to be used in the end product. However, before the sale, these materials are usually packed in the secured packing and stored in a separate warehouse for invoicing and sale to the dealers or customers. 3. Sometimes the supply condition of the after sales service can be an individual part of the bill of material in the CKD, completely knockdown condition. For example, in case of a vehicle, just 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 a bulb can be called a after sales spares, it being a part of the bill of material, which is a headlamp, and the customer may need this bulb for replacing and making the headlamp functional. Another example of completely knockdown CKD spare which may not be procured as a direct complete which may not be procured separately, but it is just a spring being a part of the bill of material, which is like shock absorber. So bill of material here is shock absorber. Bill of material earlier was headlamp. So in the shock absorber, the spring, customer may require that spring to make the shock absorber functional to avoid the jerks. Inventory measurement or valuation. Inventory measurement like bill of material for after sales service spares, also inventory is measured at a lower cost or net acquisition value. This cost here includes purchase cost, conversion cost like we discussed in the case of bill of material, and additionally packing and labeling cost. Spares incur this additional cost for packing and labeling, which are essential for sale as a after sales inventory. Here the NRV, the estimated selling price in the ordinary course of business minus the estimated completion cost and the cost necessary to make the sales. The income statement here also must show an impairment loss if the NRV is lower than the cost. Operational causes that can adversely impact the reporting of after sale service spares inventories in the balance sheet. Number one, counting errors like bill of materials, incorrect classification amongst different type of inventories. Number three, applying inaccurate rates to the inventory. Number four, valuation errors, incorrect valuation method. Number five, inaccurate disclosures. Number six, not separate reporting of the slow moving and unmoved or dead stocks. Ethical causes. Here, not accounting the sales return of after sales return spares, though customer has already been credited with sales value. Number two, including obsolete stock in the total value of the after sales service, although sales realization would be much lower. Three, including inventory stocks that have already been invoiced to the dealer or the distributor or the customer, but physically not shipped from the spare warehouse. Manipulating after sales service spares inventory by changing the material codes in stock ledger system amongst different type of spares. Number five, including defective warranty returns which are there in the company in the inventory as okay spares, but these cannot be sold. Intentional misvaluation of the after sales service. So this way, let me go back to the table. Yeah, so I have shared 35 operational causes and 33 ethical causes, where for each class of type of the inventories I have shared the operational causes and ethical causes. uh, Internal controls for the inventories of this is the additional point which I am just sharing. Inventories of each type must be subjected to the robust internal controls such as below. Number one, ordering of the inventories on vendors by authorized signatories based on the robust software like MRP2 or economic lot ordering as per the consumption estimates and need for stocking, like stocking for 15 days or 1 month or more in the case of imports. Number two, in-house manufacturing based on the proper production planning controls. Number three, robust internal control include periodic, perpetual, physical verification of each type of inventory as per planned frequency for each type of inventory to be defined. Robust controls for inventory coding for each type, quantity measurement, and material handling of inventories. Number 5, periodic reconciliation with the books and ledger stocks. Number 6, proper tagging and movement control from one location to another against authorized documents. 7, proper identification and tagging of the inventories as per the types and material code numbers. 8, robust access control to the inventory stocking areas, whether it is for bill of material or for the uh, WIP or for the finished goods lying in the depots or the warehouses, or all other four types of inventories which I have talked. Ninth, safe and secure storage and appropriate insurance policies like marine insurance policies and stock fire and pilferage policies. 10, authorization of decisions of acceptance or rejection of the seven types of inventories by the quality control team must be against documented authority level in the SOPs. Similarly, the declaration of the inventory as obsolete and dead stock and its disposal in the market by the management must be against documented authority norms. And then, of course, compliance with the standards. So, these 12 essential internal controls can enable their proper safety and recording in the financial books. Now, my second book was titled Profitability and Ethics, and it was released in November 23. And this blog is primarily focusing on the seven types of current inventories in the balance sheet. I have planned to come out with the third book, which will dive deeper into the innovative balance sheet strategies and ethical practices that can unlock profitability. You can also refer to some of the articles on your interest in the following. These are my website address, the Facebook, and the LinkedIn. Thank you very much.